Uh, Today, I think it should be largely theoretical. Corporate issuers as topics such as, structure of organizations. There is a topic on, corporate governance. So I think these are things which are more theoretical in nature, but I think as we move towards session 2 and session 3, we will have certain, numerical constructs built around the subject. So the agenda for the day is largely corporate issuers. Now, when we say corporate issuers, we are going to focus on three broader concepts: organizational forms, corporate issuer features, and ownerships. So how are the different types of entities established? What are the entities like in US? There is a LLP, there's an LP, limited partnership. So different types of organizational forms. Who are the investors and other stakeholders, and how do you handle corporate governance? And how do you read corporate governance in terms of a company's risk assessment? Let's begin with the first one, which is organizational forms, corporate issuer features, and ownership. Now, when we say organizational structures, every geography has a different framework to establish businesses, right? To set up businesses and operate those businesses. And the framework which exists in any specific geography is basically the business structure. What is the legal form? What is the organizational structure? What is the tax implications around such a structure? So the legal relationship that exists between the company and its owner is typically a business structure. The nature of this relationship between the owner and the operator, and if the owners also operate the business, is also defined under the same clause. One very important aspect of business structures is liability. Does the owner have an unlimited liability, or is the owner subjected to a limited liability? The point is, if it's an unlimited liability, the owner obviously is taking additional risk. If anything goes wrong in the business, the owner is liable for all the liabilities associated with the business if it is an unlimited liability structure. But if it is a limited liability structure, the owner is only liable, or rather, the owner is not liable anything beyond what the company has to pay. Right. So it is very important to understand what is the liability of the owner, limited or unlimited in each structure. And then obviously, critical aspect, taxation. Now, when we say types of business structure, the first and foremost, which is the easiest, is sole proprietorship, which is owned and operated by an individual, right? So there's only one person running the business. It's a sole proprietorship. Therefore, the individual is the only claimant to profit. The only individual will receive all the profits and will be liable, obviously, for the losses also. The liability is unlimited, which means if anything goes wrong with the business, the individual is responsible to pay all the liabilities associated with the business. All the profits in a sole proprietorship are taxed as personal income, right? So it's as good as personal income tax. There is no corporate taxation. And it is just, we are saying it's an extension of the owner's income, right? So if you're earning money as an individual, you are taxed as a personal income tax slabs. And if you're earning money as a sole proprietorship, you are still taxed as on a personal level. Typically, a sole proprietorship is operated when the business is on a small scale, right? So you don't have a pretty large turnover or large business. Then from sole proprietorship, we move towards general partnership, where now you have two or more individuals own and operate the business. It's a partnership, right? And as soon as we say a partnership, you have more than one individual running the business. So a partnership agreement states claims to profits and responsibilities for operating the business, right? So in this case, the profits are also shared, the responsibilities are also shared, any losses are also shared between the partners. Partners are personally liable for claims against the business, right? So once again, in a partnership firm, there is unlimited liability. You are personally liable to settle any claim against the business. And again, profits are taxed at each partner level. So again, the profits are more or less like personal income, right? So even in a partnership, it's a personal income tax that is applicable. There's no corporate taxation. So within a proprietorship and partnership, what differs is the number of individuals, right? So sole proprietorship is one person and general partnership would be more than one individual who will operate the business. Otherwise, more or less, personal taxation remains the same, unlimited liability still remains the same. So nothing changes from a liability and a taxation perspective. Let's go to the third form then. The third is a
So
limited.
sorry. Could you just
Yep.
explain what is unlimited liability again?
So unlimited liability, for example, I'm running a business and I now have to pay $1 million because I borrowed money from a bank, $1 million, and the company has no money to pay. The company is running into losses, so there is no money left with the business to pay. I raised from the bank $1 million, and I've used all that money to operate the business. All of that is now loss. So the company has zero cash, but the liability is $1 million. If it is an unlimited liability, that effectively means the owner is liable to settle that $1 million payment, and that $1 million may come from owner's personal assets. So if the owner has a home, if the owner has a car, if owner has any investments, the bank can claim $1 million against those assets, which means your liability does not stop at the corporate or the company level. Your liability comes all the way to your personal liabilities. You will have to settle it using your personal assets. And the bank has full rights to claim money by liquidating your personal assets. So that's an unlimited liability. What happens in a limited liability? The bank only has claims on the assets of the company. So if the company cannot pay a loan and the company has no assets or the company has residual assets, the bank can only liquidate company's assets. Bank cannot touch your personal assets. So that is, I think, the key difference between a limited and an unlimited liability. And which is why a lot of companies that we see around are all limited liabilities. Even if there are problems with the company, even if the company goes into a loss, the owner's assets cannot be attached in normal circumstances. You cannot claim money by liquidating or by selling owner assets. You can only sell assets which belong to the business to which you have lent money. So the unlimited liability is more risk, while a limited liability is relatively lesser risk. So as you go to a limited partnership, you explore what is called as a limited partnership structure. This is again partnership, but this is a limited partnership. Now, there are two types of partners you will find in LP, general and limited partners, GP and LP. We generally call them the general partner and the limited partners, GPs and LPs. General partners operate the business and are personally liable for claims against the business, which means general partners have unlimited liability, while limited partners, by the word itself suggests, are only liable for amount they invest, which is why they have limited liability. I'm only liable for the amount that I'm investing in the business. Partnership agreement states claims to profits, and profits are again taxed like personal income. So no corporate taxation benefits flow even to limited partnerships, right? They are still taxed at a personal income tax level. The most important format in this category is corporations, where the legal identity is separate from owners. So now a corporation has a different entity. It is not the same as owners. Owners will appoint managers to operate the business. Shareholders are only liable for amounts they invest. You cannot lose more than their investment. And profits are taxed at corporate level. But within S Corp, within corporations, sorry. Yep. Why is my pen not functioning? Just give me a minute. Or there is some issue with the pen. Check. Possibly later. Yep. So within corporations, there are two types of corporation. There is a C corp and there is an S corp, right? I will just try. Give me a minute. I'm going to try my pen settings. Just yep, works perfect. Okay. So within corporations, when you read corporations, and typically we are talking more from a US point of view. Within corporations also, you have two types of corporation, S corp and C corp, right? So the difference between S corp and C corp is one of them is taxed at corporate level while the other is taxed at personal level. So even after becoming corporation, there is a possibility you are looking at personal level taxation, like in S corp. The difference between the two is only taxation, right? Like one of them will be taxed at corporate level, the other one will be taxed at personal level. However, the most important thing is they will still have limited liability, right? So you can get the benefits of limited liability by being personal taxed, or you can get the benefit of limited liability by being at a C corp level. Now, why do the business owner think about this? Why would the business owner think in terms of whether the business should be a C corp or an S corp or a limited partnership, an LP? There's another structure in US called LLC, right, where you have a limited liability corporation. Well, the reason to think and select one of so many options, or I think the two reasons. One is liability. Do you want unlimited or limited liability? And the second, obviously, the most important along with this is taxation. Where do you think your taxation would be lower? Is it lower on the personal income tax slabs or is it lower on the corporate income tax slabs? So people do that math and then they register the business as a C corp or an S corp or a limited partnership, and you're allowed to change the format, right? If you were a company which were an S corp forever, and if you wish to convert from an S to a C corp, you're allowed those conversions over a period of time. So within corporation, as soon as we say that the identity is separate from owners, that means the company is different and the owner is different. You can take money from the company if you have borrowed, if you have given money to the company, you cannot come to the owner to ask for money. So the liability is always limited, but the taxation may depend how do you register it, S or C corp. Both of them are corporation structures. Now within corporation also, corporations can be for profit or not for profit, right? Pretty easy to remember them. Not for profit, typically established to pursue social or charitable goals. These are usually NGOs, these are usually trust, which are there for social causes. Profits reinvested in their mission rather than being distributed to owners. So because they are not for profit, if there is any profit that comes via investments that they've made, via certain activities, they don't distribute it to the owners, rather invest it back to achieve the larger social objective or the charitable objective which they have. So for us, I think more important is we have corporation, and the corporation can vary between C and S corp. You have partnerships like LP, and taxation only for corporation is at corporate tax. Everything else is personal income tax level. For example, the French retail giant Ocean Holding generated a pre-tax income of 838 million euros last year and paid corporate tax of 264 million euros. Investors in France also pay a 30% tax on dividend received. If Ocean had fully distributed its after-tax income to investors as dividend and all of its investors are in France, what is the total tax as a percentage of the pre-tax income? So you have 838, you have 264, and you have 30% as two numbers. Perfect. Let's just quickly set this up in a small Excel to do the math. Let's open up my Excel sheet. Okay, perfect. So here is the Excel. So we have the numbers which are pre-tax income. We have been given a pre-tax income of what was the pre-tax income number? 838 million and corporate taxes of 264. So we have 838 million euros as pre-tax income. And we have paid taxes of 264 million. Remember, this is my corporate tax. And it also says there is a tax on dividend which has to be paid, which is 30%. So now the idea is if you have paid 264 million euros as tax, you have already paid 31.5% tax. 264 divided by 838 million euros. That is already a 31.5% tax on corporate paid. So what is left over after tax income? We are going to say after tax income left is 574. And if I'm going to distribute all my after tax income, which means if I distribute all this income, the tax that I'm going to pay on this is 30%, right? So out of this, I'm going to pay 30% tax of 172.2 million, which means my total taxes is 264 paid here plus 172.2 paid here. It's 436 million euros of taxes paid, and that divided by 838 pre-tax income is a cumulative 52.1% tax. That is my net tax rate. That's 52.1 million tax. 52.1% is the total tax rate that the company had to pay. So the company needs to be cognizant of the fact that does paying dividend make a lot of sense if the taxes are very high, or is there any other way to distribute the capital to the shareholders? Right? In this case, half of the company profits have been taxed via corporate income tax or dividend taxation. So as a person who's going to evaluate some of these elements, we need to be very sure that how the taxation works. I know our course is not a taxation course, but we cannot stay away from taxation for a long period of time, given it has an impact on several decisions taken under the ambit of finance. So yes, 574 multiplied by 30%, 172, 264 plus 172 divided by 38 is 52.1%. Now, in the structure perspective, then there are also companies which are called as, or corporations which are public or private. Now, it is not necessary every company is publicly listed, right? Public corporations are companies or corporations where the shares are traded on a centralized exchange, and you should have a minimum number of owners. When we say their shares are traded on an exchange, you are publicly listed. And if you're a publicly listed company, a lot of information is also publicly available, right? You are going to make your public filings. Your data would be available in the public domain, and people can buy or sell your shares. There is enough liquidity to do that. As a private corporation, that does not mean the definition of a public corporation, which means the shares are not traded on an exchange. This means private corporation can become public by launching an IPO or initial public offer, sell your shares to the public, or a public company acquires you, right? You are a private company, but a public company acquires you, you automatically become part of the public company, and now you're no more a private company. Or you can go for a direct listing of shares. And the one which was the hottest topic of discussion in the 2020-21 timeframe during the COVID timeframe is SPAC. SPAC was the buzzword in 2020-21, Special Purpose Acquisition Company. The word explains it a bit. The purpose of this company is acquisition, which means these are companies which were set up only to acquire other companies. So a SPAC raised money from public, right? And how did they raise money from public? Via IPO. At fixed price. The SPAC price were always fixed, $10 per share, right? So if I am running a SPAC, I'm going to sell my shares to you, $10 a share, and I'm going to become public. Now by selling $10 a shares, let's say total raise, I have raised, let's say $100 million. So now I have $100 million in my bank account. I've sold my shares to you for $10. And now with this $100 million, I'm going to acquire a company, right? So if I acquire a private company, it automatically becomes public because I am publicly listed as a business. That company gets merged into the SPAC, right? So a lot of SPAC deals have happened in 2020-21 where the SPAC has acquired companies and those companies were eventually merged into the SPAC and all those private companies then went public. So these are options by which you can become a publicly listed company. The public corporations can also go private. So you can go reverse, right? We just talked about private becoming public, right? And we said a SPAC can help you do this. In the same setup, a public company can actually go private. Now this can be done via possibly, let's say, an LBO. An outside investor purchases all of the company's outstanding shares and subsequently delist it from the stock exchange. I think one very good example that comes to mind for LBO is Dell. Dell was a company which was listed in the equity markets in US, and the laptop manufacturer was purchased by a private equity company and was taken from public to private. Now Dell is a privately held business. So there is a possibility that you can find companies which go private from a public status. And then there is management buyout. Achha, what do we mean when we say leverage buyout? Remember, leverage buyout is buying companies using large amount of debt. LBO is debt-based M&A. You have taken a lot of debt from the market, and using that debt or using the leverage, you're going to buy companies, which is why they are called as leveraged buyouts. Management buyout, on the other hand, is companies managers purchase all of the company's outstanding shares and delist it from the stock exchange. Sometimes company management can execute an MBO. If they have enough money, they can buy the company from the market, and that is called as an MBO, management buyout. Private corporations, on the other hand, can raise equity capital by selling shares privately, but only to accredited investors, which are, venture capital, private equity investors, institutional investors, or not. Right. So private corporations can raise money from VC, PE, right? And that is typically what is called as accredited investors or initial investors. They're still selling shares. Their primary objective is sell shares and raise money. Now consider an example. A corporation that has no need for new equity financing, its debt needs are satisfied through existing bank credit facility, and it has majority owner who exercises control, management control of the company. is this issuer more likely to go public or private? I think think about it. They do not need money. Their debt is already taken care of through their existing facility, and gradually the debt will keep falling and the facility will become more comfortable. And the majority owner has control on the company. So why would you like to sell your shares and lose control, right? The only reason why you sell shares is if you need money. But if the company has no need for equity financing, debt is covered, the management is not going to typically sell any part of the business. So overall, I think they'll remain a privately held business. Fair enough. Questions on the first leg of our reading?
So sorry, could you explain the previous slide again? It's a bit confusing.
Yes. So the idea is think about it. You are a startup. A startup needs funds, right? And if you need funds, you sell shares. As soon as you sell shares, your ownership in the business reduces, right? Because now you have external investors. Now, in this case, the company has no need for financing, which means they don't need money. They have enough money. And if they have already enough money, they don't need funds. They are not going to sell shares. And if they don't sell shares, they will have complete control of the company. The majority owner will continue to be controlling the business. So if you don't need funds, you don't want to lose control, so do not lose control. Simple. In these two cases, you don't sell your shares and you will stay as a private company, privately held business, not a publicly held business. So that is, I think, what is implied through this paragraph. Okay, perfect. Questions? Nothing? Okay, good. Sure, then let's move to the next one, investors and other stakeholders. Next part of our reading is investors and other stakeholders. Just give me a minute. I'll get a glass of water. Forgot to carry it with me today. Thus, I'll be back in a minute. Yeah, let's get started again. Now, what are the types of investors and other stakeholders that we are looking at in each of these businesses? So when we are saying investors and other stakeholders from the perspective of each company, right, or each organization, we are looking at first in terms of debt or equity. Now, always remember a company can get capital in three formats, right? There are only three capital providers to the business. First one is debt. You can borrow money. Second is equity. Within equity, you can make a classification and you can say there is a common shareholder, common equity, or there is a preferred shareholder, which means you have a preferred equity share, right? So you can sell a common share or you can sell a preferred share. Now, the corporate issuers or the corporate businesses can be financed either through debt or equity. Debt holders will provide finite capital. They will never fund the business entirely. The reason is if a lender provides you 100% of the funding, then as a owner of the business, I am not interested in running the business. Even if the money goes down the drain, even if there are losses, even if the business does really bad, it is not my money. It is a lender's money, right? So in general, lenders will never provide infinite capital. What they may finance as a percentage of your requirement varies. 30, 40, 50, 60% they can finance. But the more they put money into the business, the lesser maybe you're incentivized to run the business because it's not your money. So debt holders provide finite capital. They have a legal claim to the principal and interest, which means you have to pay them their principal amount back along with the contractual interest payments. They also have a higher priority of claim than equity holders, right? So whenever the company is going to distribute money, and that distribution can happen in good or bad scenarios, right? Good scenarios, for example, your company gets acquired. Bad scenario, the company is going bankrupt and you're shutting down the company. In either of the cases, they have the first priority, which means if the money is getting distributed, they get the money first. And the upside is limited to full repayment, no decision-making power, right? So the point is their upside is also limited. Their risk is also low, right? They take lesser risk and therefore they have low returns. Their risk and return both are low. Why do I say they have upside to full repayment? The maximum they can earn is their principal plus interest. For example, if I take $100,000 from you as a loan, and I say I'm going to pay you 10% interest per annum, which means end of the year one, I'm going to pay you $110,000 and finish, which means the maximum you make is $10,000. But think about it, by using your money, I did something really good about the business, and now the business is ready to increase in value. You will not get anything beyond $10,000. Your upside is limited. If the company does really well from here, all the profits will belong to the equity shareholders. But you also have a benefit. If the company goes down, company does really bad, you get a priority and I make first payments to you. So it's low return, low risk strategy. And I think the debt holder understands it when invested into a business. Obviously, these guys may not get decision-making power, and I'm using the word may. In certain cases, debt holders may get board positions, and in that case, even they may get some decision-making power. But in most of the cases, they don't have a decision-making power. Equity investors, on the other hand, are the shareholders or owners, and they typically provide permanent capital to the business. So the shareholders and the owners of the business. Technically speaking, even if you buy one share of a company, you are an owner in the business, right? You are a minority owner in the business. Your stake may be very less, but you are still an owner of the business. They have a residual claim to the assets after all other claims have been paid, which means if anything is left, these guys are the residual owner of those assets. They get the residual claim on assets. All the remaining profits belong to them. Hence, they have potentially infinite upside because after the debt payment has been made of $110,000, everything can be distributed to the equity shareholders. So they have an infinite upside. Now, in all this, the interest of debt and equity holders may conflict due to their different claims. The equity holders will support decisions that enhance a corporation growth rate and risk levels because the equity guys are taking high risk, right? Because they are taking high risk, they want high returns. And in order to generate returns, they may want to support decisions that enhance a company's growth rate and risk because they know they will only make money if the company does well, if they're going to take a risk. While the debt holders will object because the debt holders would want the risk to be lower so that the company does not go bankrupt and pays the debt back or pays the loan which has been given back by the or which has been given by the lender. So there may be a conflict between the two in terms of the claims or in terms of the way the business is operated. So their risk and return, debt financing has lower cost to an issuer, but it has higher risk. Contractual obligations to pay principal and interest, lender restrictions. So the idea is debt is cheaper. When I say debt is cheaper, if you go and borrow money from a bank, the bank can offer you money at a very nominal rate. Like in US, you can get loans for 6%, 7%, 8%, 9%, 10%. You can get loans between this rate. Very low cost financing. But remember, the more debt you borrow, the more interest you will have to pay, and the more is your risk because you have a fixed payment obligation, which is why we say debt has higher risk. You are contractually obligated to pay the money. And when you take debt, the lender also puts some restrictions on the business. These restrictions, if you remember in fixed income, we call these restrictions as covenants. The lender may give you certain covenants. Covenants will mean you cannot do XYZ things because these things are detrimental to the interest of the debt holder. So there is both goods and bads of debt borrowing. You get it at a cheaper cost. It is less expensive as compared to equity. However, the disadvantages are you have to make a fixed payment. There may be restrictions and the debt increases leverage. Last time when we did financial statement analysis, we talked about leverage ratio. And in leverage, we talked about this ratio, debt upon equity, solvency ratio or leverage ratio, debt upon equity. And higher the debt, more the problem from a business perspective. Now, from an equity investor perspective, they have theoretically unlimited upside return, but they also take higher risk. So dilution or reduced fractional ownership from new equity issuance is also a risk. What is dilution? Think about it. Two individuals start a business, right? And both of them have a 50% share in the business, right? So individual A, individual B, they started a business 50% share. Now what is happening? After this, they got another investor in the business. So they asked money and C said, I'm going to invest in your company. So as soon as C says, I'm going to invest in your company, now C also needs shares. So what happens? Both of them decide, okay, we have 100 shares each. Let us give C also 100 shares. So now, as soon as C comes into the business, A, B, and C, all of them have 100 shares. and all of them now have 33% ownership, which means A and B diluted their ownership from 50% to 33%. So they have reduced their ownership because new money or new equity was issued, new shares were issued. So this is a fundamental problem with equity, that every time you raise money, there is a possibility that you will lose a part of your business. You will lose a part of the ownership associated with the business. So that is a risk that equity investors live with. So it's not one fits all, right? Everything has its pros and cons. Everything has its advantages and disadvantages in terms of financing. The maximum return and loss summary. So when it comes to maximum return and loss assessment, debt holders and investors differ. For debt holders, as we said, the maximum return is capped. They get their principal plus interest. While for equity investors, the maximum return is unlimited. The company can go to $10 trillion market cap. The company can go to $100 trillion market cap, right? The more the company value share price increases, the more is the upside. For debt holders, the maximum loss is initial investment. You will lose the investment you have given. Same for equity investors, initial investment. The only thing is debt holders get a priority whenever payments are distributed, first priority, and equity holders may get a second priority when payments are distributed. So they get money, which is residual claim. So maximum return and maximum loss for debt and equity investors. Give it a try. Corporate equity and debt holders share the same investor perspective with respect to. Let's do a quick couple of questions. So corporate equity and debt holders share the same investor perspective. Look, their investment risk is not the same. Their risk return potential is also not the same. So the only thing that is same between the two is maximum loss. The maximum loss both of them will face is their investment amount. Right. So the only thing that is common between all of them or equity and debt is their maximum loss. Because the maximum loss both of them may face is the investment amount. All of the following are characteristics of debt except limited liability, priority in payment, unlimited return, right? They don't get unlimited return. We've talked about it. Unlimited return is a feature of equity, not of debt. But yes, they have limited liability, which means they only lose what they've invested and they get a priority in payment. Now, in corporate stakeholders, we also look at corporate stakeholder theory, right? So when we say corporate stakeholders, there's a stakeholder theory that we should try and discuss. Now, the stakeholder theory primarily centers on the concerns of companies' owners with other entities taken into account only in relation to their influence on the company's stock value, right? So the idea is, or the concept is, the owners generally think with other entities like debt, what will be the influence on the company's stock value? Because the owners would be interested in the company's stock value. That is, stakeholder theory encompasses the interest of all stakeholders with a particular emphasis on addressing and mitigating conflict among various groups like debt and equity and preferred. ESG considerations are also often integrated into this framework, which is the environment, social, and governance related considerations are integrated into this framework as well. So let's look into details of this. Now, corporate governance is one of the ways to manage this. The conflict between different stakeholders, the conflict between managers, the conflict between employees, the conflict between the owners, everything can be managed using corporate governance standards. So corporate governance as a broader concept strives to minimize and address potential conflicts, that may arise between the company and its diverse array of stakeholders. Classical example, you could have each stakeholder may have a different opinion about how the business should be run. And in such a case, how do you decide what is wrong, what is right, and take an action? Corporate governance lays out a framework for it. These stakeholders encompass a wide range of entities with a vested interest in the company, right? So you could have debt and equity investors, board of directors, managers, employees, customers, suppliers, and government. Everyone is a stakeholder. The word is stakeholder. The word is not shareholder. This is stakeholder. Okay. So how do we ensure that the vested interest of all of them is taken care of when a business is operational? In this category, we will come to ESG consideration in a minute, right? I want to look at some corporate governance mechanisms. Okay, let's finish ESG and then let's go in the sequence. Let's not jump. So within corporate governance also comes a bucket of ESG. Now, ESG is not mandatory. It is not mandatory for you to invest based on the ESG theme. ESG integration is the act of considering ecological, social, or environmental, social, and governance elements in the speculation procedure or in your investing style, right? So this should be environmental, social, and governance elements. Now, within ESG, you can have a positive and negative screening. Positive screening means those sectors, those organizations, those companies which are aligning themselves with ESG related standards, operations, and procedures, right? So all the companies which are positive for environment, society, and governance are your ESG compliant companies. You can call IT companies as ESG compliant, right? And you can say, okay, environmentally, the traditional software business does not impact the business or environment a lot. Obviously, yes, the artificial intelligence may have a lot of data centers and blah, and you could have carbon credits and all of those things can come into picture, carbon emissions, etc. But historically, let's say an IT company is the one which doesn't impact your environment a lot. It's society positive. It does give a lot of job opportunities to people, and governance wise, these companies are great. So you can say positive screening, IT companies are the first starting point for us. And maybe you can put educational businesses, again, positive for environment, society, and governance. You may find some good educational oriented businesses. But then the important list is negative screening, in which what sectors you would like to remove from your portfolio if you align yourself with ESG. So this is the most common ESG investment strategy. It refers to the practice of excluding certain sectors, such as companies engaged in fossil fuel extraction or production, or excluding companies that violate accepted standards in area like human rights or environmental concern. So, companies such as companies operating or, manufacturing tobacco, companies which are manufacturing oil and gas, companies which are, diamond oriented businesses. These are, typically businesses, entities which may have negative screening, because some of these businesses, mining, because we are talking about human rights, mining is a business which is negative for ESG. All your, non-renewable energy sources like coal is a negative ESG consideration. So any company which is negative for environment, society, or on governance standards will be part of the negative screening list. And you have to now align yourself to a portfolio. Do you believe you want to invest into a portfolio which is positively aligned or negatively aligned from a ESG consideration perspective? It's not mandatory. As I said, ESG consideration is completely optional. You want your portfolio can follow this consideration. If you want, you can exclude the consideration. And then comes thematic investing. Strategies commonly considering a single factor, for example, vitality, productivity, or for environmental change. So within ESG, you can find themes. Do you want to do solar-based, assessment? Do you want to do wind turbine? What type of theme you want to pick and work with? So those are your ESG considerations. Now, what could be the environmental issues in depth? Climate change, carbon emission, most talked about. So a lot of people stay away from, a business such as Formula One, right? And Formula One, car racing, a business, private equity backed business. But again, a lot of people may not want to invest into a Formula One, business or a team if they are looking at carbon emissions, because some of these will burn fuel and it may not be positive from a climate perspective. Again, anything related to pollution, biodiversity, deforestation, energy efficiency, waste management, water scarcity, all of this typically goes to environmental issues. Then there are social issues, customer satisfaction and product responsibility, data security and privacy related issues, gender diversity related issues, occupational health and safety related issues. So any business operating, or solving some of these issues is positive from a ESG social aspect perspective. Any business which is impacting or is on the negative side of these issues is a cause of concern for a lot of people. So it's a social issue that we are looking into. Then comes governance issues, where you have problems related to bribes, corruptions, whistleblowers, lobbying, political contributions. So anything which is negative on governance, where you believe there is a governance issue. In such a case, you might want to stay away from the business if you are ESG compliant. So it's a choice which fund managers make. Do they want to invest based on ESG or not? This is also known as responsible investing. The simple way to assess, think of this as investing with a conscience. So when we say responsible investing, you don't just look at profits, you also check how a company treats the environment, its employees, and society. Example, instead of buying stock in a company that pollutes rivers, you might choose one that invests in renewable energy or recycle waste. So basically, all these securities will be out of your portfolio. It's an umbrella term that includes ESG integration, blending environmental, social, and governance data into stock selection. Socially responsible investing, you can call it the same, call it thematic investing or impact investing. Right. So it is up to you. What do you want to call it? More or less, it's all the same. Then sustainable investing. This goes one step further. It's about long-term survival of both the planet and your portfolio. Example, you want to invest into businesses which are manufacturing products which are sustainable. Like, for example, a lot of people now look at to buy products which are manufactured from sustainable fabric, right? So even in fabric, you have sustainable and non-sustainable type of fabric. So a lot of people now look to buy those clothes which are, sustainably good, and those are something which is not impacting the environment, right? So investing in companies working on clean energy, water conservation, or waste reduction, because they are more likely to thrive as sustainability becomes a global priority, right? So again, you would like to participate via this route. And then there is a socially responsible investing. Avoid industries which are bad, typically like tobacco, gambling, weapons. From an investment perspective, yes, some of us will exclude these companies from our portfolios, right? But again, it's not mandatory, because if you think defense is going to do great as a story, and if you're a fund manager who is not 100% aligned with ESG, you can take a bet on defense and make some money for your shareholders or for your unit holders. So that's up to us in terms of social responsible investing. Do we want to participate into these businesses or not? Thematic investing, as we said, specific theme or trend. And again, the trend should be connected to ESG, right? So electric vehicles is a theme. Betting on cleaner transportation. Green infra is a theme. Companies building solar plants or smart grids. And then gender equality. Firms with strong women leadership. You want to pick those companies. Just give me a minute, please. Right, perfect. Sorry. Yep. So thematic investing effectively will be based on either electric vehicles, green infra, and again you can add themes to this based on your things that move around in terms of thematic investing. And then comes finally obviously impact investing. This is where finance meets purpose. You invest into projects or companies that intentionally create a measurable positive impact on society or the environment and still generate returns, right? So impact investing would be more projects which are social infra project, like, healthcare, clean water, sanitation, sewage. So that is where you are putting the money and investing from an impact perspective. Microfinance typically on from a rural perspective, right? So these are businesses or areas where impact investing plays out. So from a strategy perspective, focus and example, responsible investing, sustainable investing, socially responsible, thematic, and impact investing. The focus varies. As a portfolio manager, as a fund manager, you are looking at either of them depending on what your criteria is, what your objective is. And that is what we are trying to play around with. Now, there are also risks and benefits, right? So ESG, because it impacts both your portfolio risk and returns. Therefore, ESG may have negative and positive impacts. Remember, excluding sectors from your portfolio will have an impact on the return. Simple way to think about this is if you do not invest into defense, let's say you don't want to invest into sector which is negative from a social perspective. So if you put defense out of your portfolio, and if the defense stocks do really well, your portfolio underperforms, right? So from an ESG perspective, there is a negative impact. So a determination of whether the ESG factor is significant or not is necessary. And the quantification of ESG factors and their incorporation into discounted cash flow analysis. We need to quantify this element. An evaluation of the company's performance and ratios will concern ESG considerations, right? So, which is why you won't see fund managers who are completely aligned to ESG. There are only few who have a mandate to invest as per ESG, guidelines. However, it's not acceptable across everyone. A lot of people still may not align with from an ESG perspective. But if you are going to align yourself with ESG, you will have to quantify what were the factors, and you will have to evaluate the performance and ratios concerning these considerations, right? What happens to your fund returns? an appraisal of the influence on debt holders and equity investors, and an assessment of the short and long-term risk associated with these factors, including potential long-term risk, such as possible asset devaluations. Please remember, ESG is positive for environmental, social, and governance aspects, but the investing aspect of ESG may lead to underperformance or outperformance depending on what the markets typically do. So as a fund manager, as a portfolio manager, if ESG is something which is itself a theme, right? We are saying within ESG there are so many themes, but ESG itself is a theme. If you align yourself with ESG, ensure you are able to quantify, evaluate, and assess the risk associated with these factors in terms of how the portfolio will move. Because you would like to showcase all of those things to your potential investors or prospective investors also. And these are the risks that you are trying to factor in. Perfect. Questions? Any questions that we can take before we move to the next part of our reading? Nothing? Okay. Perfect. Then let's move to corporate governance. And what are the conflicts? What are the mechanisms to resolve these conflicts or manage the conflicts? Risks and obviously benefits. And remember, corporate governance is an area which a lot of people do not pay focus on or do not put focus on, emphasis on. However, corporate governance becomes, I think, the backbone of a business. End of the day, if the corporate governance there's a compromise on this, you may see a lot of business value may get eroded in a very short period of time. Corporate governance related issues are not taken very easily by the market, right? And I think that there are serious repercussions for the businesses which have poor corporate governance practices. So a section which has no numbers, but it is extremely important to assess the corporate governance practices of a business. Now, from a corporate governance practice perspective, the shareholders are not the managers, right? Typically, if I'm buying a share in a company, I'm not the manager of the company or I'm not doing anything in the business, right? And therefore, there may be a conflict of interest between the owners and the management and the directors, creditors, employees, customers, and other stakeholders. Everyone looks at the company from a different perspective, right? Like as a customer, you are looking at the company from a continuity perspective. Will the company continue to operate and give me service after I've bought a product from you? As an employee, we have talked about this previously, the employee is more concerned about salary. Will the company be able to make salary payments? So there may be conflicts between each stakeholder or a group of stakeholders. And corporate governance, therefore, is the overall construct within which a company is managed. Corporate governance typically will protect shareholder interest and the measures that are put in place to protect these interests. One, code of conduct, discipline, etiquettes to be followed, checks and balances, which are known as your internal control processes. And there is a charter of responsibility that each stakeholder has a responsibility towards the business. The foremost important thing in corporate governance is a channel of communication. Communicate the good, the bad, the ugly to your shareholders. That is the core of corporate governance. Hiding data or not disclosing information and keeping it behind a closed door is generally an area of concern for shareholders. And as a stakeholder, a lot of stakeholders would like to understand how big the problem is. That can help them to take corrective measures as and when the problem arises. So the communication is important and what is happening. If there is no communication, there is uncertainty. And especially equity markets do not like uncertainty. If you come out in the public and if you say, okay, we did a mistake, we have lost X amount. However, this is our learning and this is a one-time mistake. The initial reaction may be the stock falls, but in short run, the security will bounce back because the management has a plan, the acceptance there is a problem, and the plan to resolve a problem. So communication is utmost important in corporate governance. Corporate governance therefore provides framework that defines the rights, roles, and responsibility of different groups, which means groups pertaining to management, controlling shareholders, minority or non-controlling shareholders, and board of directors. And we are trying to minimize and manage the conflicting interests between these insiders and external shareholders. All of them are insider to the business, and people like us are outsiders or external shareholders. Now, what are the good practices in corporate governance? And not all of them, it's just a list of them. Board accountability. Board acts in the best interest of shareholders and stays independent from management. So the board of directors should primarily focus on shareholder interest, and they should not be influenced by the management. The board and the management would be different, right? The board of directors obviously let the management work, and the management doesn't interfere in what the board does, right? So the two entities or the two groups should work independently. Ethical conduct. Company operates lawfully and ethically with all stakeholders. Equal rights. All stakeholders have equal, well-defined governance rights. Now remember, these all shareholders have equal rights. The category of shareholder may change, right? So for example, preferred shareholders, and within preferred shareholders, there may be Series A, Series B, Series C preferred. All three of them can have different rights, but that should be defined in the agreement. That, okay, Series A has this right, Series B has this right, and Series C has another right. Strong control. Management is guided by proper checks and procedures, which means the internal control processes should be robust. Example of internal control processes could be information leakage. The information should not, let's say, be leaked before it is made public. Simple, a classical example, financial statements. The auditor prepares the financial statement. A part of the company knows the financial statement. The CEO knows what the financial statements are. The CEO knows how much will be the profit. Along with the CEO, a lot of people in the accounting team, auditing team will know what the profits will be. This information should not be available in the market. This should not be leaked. This should be disclosed through a public filing, because if such an information is provided outside, then there's a very poor control on internal processes. Then people can take advantage of insider information, and using that insider information, a lot of people can make money, and that is something which is prohibited. So there should be full checks and procedures to ensure that people don't share information, don't communicate the information out. This may include, email restrictions. This may include, this may include basically any access to unauthorized documents, office areas for everyone or only for selected personnel. And transparent reporting. Financial and operating information is shared fairly, accurately, and on time. Now, a lot of people say, I've shared the financial statements, they were fair, they were accurate, but they were filed after 300 days. 300-day old statement is of no use. It may be accurate, it may be perfect, but it is a stale instrument. I want to value, or I want to look at the statement in a more timely manner, right? So because the timely statement provides me a better picture of the business. Who are these stakeholders? We've talked about previously: shareholders, creditors, managers and employees, which means senior management of the company and obviously employees, board of directors, customers, suppliers, and government or regulators. Now, what is this principal agent relationship? The word principal agent relationship will be covered across different books several times in CFA. The board of directors are appointed by shareholders, right? The shareholders basically approve a board. And the board of directors then take care of the management, right? So the shareholders are the principals and they run a company by an elected board, and the board is going to appoint the managers and the employees. In this case, an agent is also hired to act in the best interest of a principal, which is best interest of the shareholder. So the conflict may arise between agent's interest and the principal's interest, resulting in agency cost. Now, at times, the management who is appointed, that management is acting as an agent for the principal, which is the shareholder. But if the management starts behaving in a fashion in which is detrimental or negative for the shareholder, then there's a conflict. And whenever there's a conflict, you result in something called as an agency cost. Types of agency cost: insufficient management effort of time, which means attention and monitoring; misaligned incentives leading to too much or too little risk sharing; self-dealing, where management prefers to maximize personal benefits and start dealing on their own accounts; empire building, leading to the growth for growth's sake; and entrenchment, leading to managerial actions that help retain their jobs. So these are all types of agency costs. These are all things that can go wrong from a business perspective. These are all things which will happen if there's a conflict between the employee and the employee interest is not taken into consideration and management starts behaving in their own interest. Perfect. Questions. Questions before we take our mandatory break, and I think the only break for the day. But questions, anything before we head into a break? Okay, perfect. Then take a break, 20 minutes, and I think that should be the only break. We will assemble again in by 12:40 p.m. IST. Get started then on the remaining aspects of this reading. Just quickly erase this. Okay. Now, when obviously we talk about shareholders, it does come to voting rights also. Now, there are two types of shareholders: controlling shareholders and minority shareholders. Controlling shareholders, as the word suggests, has a controlling right in the organization. The controlling shareholder obviously can take decisions and can influence the way a company's operations run or decisions are made. Minority shareholder, on the other hand, has a disadvantage. The minority shareholder is dependent on the decisions taken by the controlling shareholder. So if the controlling shareholder takes a decision to, let's say, diversify the business, right? You are a company which is into automotive components. And if the controlling shareholder decides to diversify the business from automotive components to coffee chain, right? Let's say a cafeteria or a coffee business. It's an unrelated diversification and it can go good or bad. If things go bad because of the diversification, the impact is on the minority shareholder as well. And the minority shareholder can't do much with respect to the decision. However, the minority shareholder does have certain rights. These rights may include voting rights. So you could see how voting rights help. There could be related party transactions that can be a warning sign for certain people. Or there could be non-voting or limited voting rights. Those are also available in certain categories of shares. You have limited voting rights or no voting rights. Then there are manager and board relationships, which have to be studied, and shareholder versus creditor interest has to be managed. Let's talk about each one of them. So a controlling shareholder of Still Creek Corporation owns 55% of Still Creek's shares, and the remaining shares are spread among a large group of shareholders. In this situation, conflict of interest are most likely to arise between shareholders and bondholders, the controlling shareholder and managers, the controlling shareholder and minority shareholders. Now remember, there is one controlling shareholder and the remaining 45% is spread across a group of shareholders and a very large group of shareholders, which means there is no information provided around bonds here, right? We are largely looking at only shareholders. And therefore, in this case, the conflict can only arise between controlling and minority shareholders. Controlling shareholders could make decisions which are not in the best interest of minority shareholders. And the minority shareholders will have to live with those decisions till they are part of the company, right? Obviously, if you sell your shares, you can exit the business, then there is nothing which is applicable. But if you're part of the business, you are still dependent on the decisions which are made by the controlling shareholders. So this may result into a conflict between the two groups. Now, a construction firm has the opportunity to invest in a high risk, high reward capital infrastructure project. Which of the following could be a reason why the company decides not to pursue the project? First, the compensation of manager is closely tied to the size of the company's business. Second, management receives all cash compensation. Management has recently received a generous option reward in the company's shares. Now, think about it. The opportunity is to invest into high risk. Sorry, the opportunity is to invest into high risk, high reward capital infrastructure project. And which of the following could be a reason why the company decides not to pursue the project, right? What could be the reason why you would not like to pursue the project? The simple way to look at this is the managers, when they receive cash compensation, in such a case, the manager does not want to take a risk because their compensation does not depend on the company doing good or bad. It's more or less cash compensation. So if they would like to protect their cash compensation, they would not take risk. And in such a case, we can say that the management receives excessive all cash compensation. And that is a possible reason why the company decides not to pursue the project. If the management compensation was associated with the size of the business, the management would like to take the decision to take the project because by taking the project, the size of the business may increase and management compensation can also increase. But that is not the case. And options, if provided, once again, management would like to take risk because options will only pay benefits if the company value goes up. And the company value will only go up when such high reward projects do well. In both cases, the management has no incentive to take risk because their returns are not based on securities. They are getting cash compensation. And if there is cash compensation, why take risk? You can continue operating the business the way it is currently ongoing. Now there is also called as dual class structure. A lot of companies offer multiple classes of shares. It's not necessary only in US. Across different geographies, you will find multiple classes of shares. So some companies issue two or more classes of shares that give different voting rights to different group of shareholders. The classes of share itself vary in terms of their rights and preferences. The rights and preferences change between each category of share. This allows founders or key leaders to retain control even with small ownership stakes. Example, Meta or Facebook, Mark Zuckerberg holds Class B shares and each share carrying 10 votes per share, giving him majority control. While Warren Buffett's Class A shares have a very high voting power and Class B shares have a very low voting power. Also remember, the price of Class A and Class B share could be very different. The Class A share, for example, for Warren Buffett's Berkshire Hathaway trades, and in Indian currency, I'm aware about it, but let me just quickly showcase the price difference to you. So if I say Class A Berkshire Hathaway stock price, you will look at the Class A Berkshire Hathaway stock trades at a value of 716,000 US dollars, right? So we are talking about 716,000 US dollars of a Class A share for Berkshire Hathaway. If you see Alphabet has a Class A share, right? Once again, Google or the parent Alphabet has a Class A share. And the same thing, if we say Class B Berkshire Hathaway, it would be a very, very low pricing for a Class B share. For Berkshire Hathaway Class B share as compared to Class A share, trades at $477. It's a significant delta that we are looking at when we are looking at these securities. So the idea is Class A, Class B shares, different categories of shares have different rights, different preferences. Their pricing is dependent on those variables or those elements. So which of the following best describes the dual class share structure? Dual class share structures can be easily changed over time. Company founders can maintain significant power over the organization, or conflict of interest between management and stakeholder groups are less likely than with single class structures. Generally, dual class structures are issued to give control to the management, right? So the company founders can gain control or have power over the organization. So those are the primary reasons to issue dual class structures. Now, in these dual class structures, you may also hear words such as DVR. In certain geographies, you will also hear words such as DVR. So there are shares which are called as differential voting rights. So in certain securities, you will have shares which are called as DVR, differential voting rights. So you could have Volkswagen, normal share, and you could have Volkswagen DVR, which means this share and this share have different voting rights. Obviously, reduced voting rights. And if I take away your voting rights, along with reduced voting rights, I offer you higher dividends. So if you buy a DVR share, your voting rights will be taken away from you, or you will be given lesser voting rights. But to compensate for these lesser voting rights, what a DVR share may typically do for you, offer you higher dividends. So as a retail shareholder, as a small minority shareholder, this is a win-win for you. Because as a minority shareholder, your voting rights anyways did not carry a lot of benefits. right? You were minority shareholder, minority voting rights, but you would prefer to get higher dividends because that is what your income is. Higher dividends is typically what you would like to continue with. Now, stakeholder management. It includes recognizing, organizing, and understanding the interest of stakeholder groups, and on the premise, dealing with organization associations with these groups. So each stakeholder is important, and there are certain actions that need to be taken to maintain stakeholder relationships and management. The mechanism to do this is first general meetings. The companies should conduct general meetings, and by way of general meeting, the companies should present their performance, discuss things necessary from a stakeholder perspective. So annual general meetings are one of the ways to tell your stakeholders what the business has done, how the performance has been, and what the management is looking forward to, right? What is the next few years the company is going to focus upon? So stakeholder management is something which should be taken seriously by way of board of or by way of one general meetings, right? This could be annual general meetings. This could be, uh, extraordinary general meetings, EGMs, right? So if there is some decision which has to be taken during between the year, you could do an EGM or have an extraordinary general meeting. Then board of director mechanisms. Again, selection of the board, will the board be, churned? Everything needs to be taken into consideration. How long will people occupy the board? Will there be independent directors on the board? How many independent directors? All of them needs to be taken into consideration. Next, audit function, critical, right? You cannot go wrong on audit. Your financial audit or any other type of audit like an HR audit, internal audit has to be on point, right? Anything goes wrong on the audit side of the business, it's a risk to the business. Is the risk which follows is reporting and transparency risk. If shareholders or your stakeholders lose confidence in the firm, then the firm can collapse very fast, right? Your customers may fly, your employees may just jump the ship, they may just find another job, and the lenders may stop providing funding. All of this could combiningly have a catastrophic, you know, event for the business. Then policies on related party transactions. Now, related party transactions by themselves are not an issue. There is a possibility that your company deals with subsidiaries which are related parties. For example, one of your subsidiary is into steel and the other subsidiary is, let's say, manufacturing cars. So there is obviously a relationship between the two because your car manufacturing unit or car manufacturing company is going to buy steel from your subsidiary, which is manufacturing steel. So related party transactions are absolutely legal. The only problem is there should be policies around it. For example, at what price will steel be sold to the car manufacturing companies? It should not be way below market price, right? Otherwise, that's not a fair pricing. What should be the payment terms, right? So it should be very similar to any other market participant. Then one of the ways to manage stakeholder management or do stakeholder management is remuneration policies. What are your remuneration policies? Are the remuneration competitive or are you paying above the market remunerations, below the market remunerations? So policy should be in line with what the market is. Look, if you're going to pay less, your employees may not be happy. If you pay more, the shareholders will not be happy. So we need to find what are competitive pays, what is the market pay, and ensure your policies are aligned with the market. Then there should be say on pay. The stakeholders should have a say on the pay. The committee which takes care of the payments, remunerations, and especially of the senior management should ensure that it's aligned with market expectations. Manage relationship with creditors, customers, and suppliers via contractual agreement, and honor those agreements, right? So if you say that, okay, we will make supplier payments in 90 days, then I think the supplier and vendor payments should be made in 90 days. You honor your commitment as per the contract, and your key stakeholder, like a supplier or a vendor, will be happy working with you. Follow all laws, regulations, labor laws, and obviously ESOPs. You may issue ESOPs to incentivize employees. Right? ESOPs are typically issued to incentivize employees. Now, board of directors, as we said, they are representative of the owners, which are appointed to ensure proper corporate governance. Like Tatas have a board which takes decisions from the perspective of the company, what is good for the company, what is bad for the business. They are more or less representative of the owners. The duty of the board is to act in the long-term interest of the shareholders. Always remember, the board has to act in the benefit of the shareholders. And one of the largest shareholder is the promoter, right? The largest category of shareholder is the promoter of the company or the owner of the company, because the owner or the promoter is technically the largest shareholder in the business. Three characteristics of board of directors: independence, experience, and resources. The board of director of any company should be independent, which means they should not be under the influence of anyone, and they should make decisions which are independent. They should not be biased. Then the board should be experienced. What type of experience? The experience could be in accounting, right? So you may have people with accounting, finance, tax experience. These guys are also necessary because you will have a function of accounting, finance, auditing, taxation. So you will need some people with experience in audit, finance, accounting, taxation. You will need some people who are experienced with HR. You need on your board industry experience. So you need people who have experience in your industry, right? So if you're a FMCG company, you will need board members who have an experience in FMCG, right? So you need people who have experience in legal and regulatory norms, right? So typically you will hire people with subject matter expertise and appoint them as board of directors. And the board should ensure there are enough resources for the business to operate. Basic features of an effective BOD. A majority of the board should be independent of the management, which means there should be no overlap. The management and the board should be different. The board should meet regularly outside the presence of the management, so that the board does not influence the management and the management does not influence the board. The CEO of the company should not be the chairman of the board, because if you can make the CEO the chairman of the board, then the management and the board are similar, right? Because the CEO is heading the management and he cannot head the board. Otherwise, they will basically become the same decision makers. The board should not consist of people who company does not or who does business such as suppliers or customers. Obviously, if you include these guys, there is vested interest. You would want independence, and you are compromising on independence by appointing customers or suppliers on your board, or anyone else who gets benefit based on certain decisions. Board members should also be qualified, have adequate experience, and should regularly attend meetings, right? So all board meetings, generally you would recommend the board of directors to attend those meetings. Things to be considered for board elections: share owners may elect board members every year or staggered multiple year terms, which means they keep changing. The board has filled a vacancy for the remainder of the board members' term without receiving owner approval at the next annual general meeting. Share owners can vote to remove a board member under certain circumstances, and the board is appropriate size for the facts and circumstances of the company. So for larger organizations, you may need more board of directors. For smaller organizations, you may have lesser board of directors. But again, there's no perfect size, right? That is something that the board has to evaluate.
So, just two questions.
For
Okay, firstly, do the board of directors, do they get paid? And secondly, must the board of directors be shareholders?
So board of directors, yes, they are paid to attend annual general meetings. There is a remuneration compensation which they are paid, and that is publicly disclosed. So the amount that they receive for each meeting they attend is publicly available. So yes, there is a payment made to them. And I'm sorry, I forgot the second question. Can you repeat?
So must they be shareholders as well or not?
Ideally, you would not want your board of directors to be shareholders, because if they are shareholders, they would like to take decisions which influence the share price, and that may compromise independence, which is why generally independent directors are appointed and they ensure they don't have any share ownership in the business. That's not something which is mandatory. At times, there are people who own a bit of the positions, but perfect corporate governance would mean no share ownership. You have no vested interest into the business, and therefore you take decisions which are not, beneficial to you, right? So you would like to keep it independent entirely. Sometimes the board of director members are not even allowed to be part or be on other company boards, right? For example, if you are a board of director on let's say a tire manufacturing company, then you cannot be the board of director member on another company which is into tire manufacturing, because then that's a conflict of interest, right? Then you cannot be part of the competitor board also. So yes, from a share ownership perspective, ideal cases, no ownership. So there is no vested interest, and no vested interest does not compromise independence.
So ideally, they should not have shares and not be in management.
Yes, they should not have shares, they should not be part of the management, and they should have no transactional relationship with the business. Otherwise, you will try and push those policies, approve those things which are beneficial to you on a larger basis.
Yeah, sorry. If I understand well, may I say that it's more applicable to the public company?
It is more applicable to the public company. The scrutiny is more in public company. Let's put it that way. The public company is more scrutinized. There is a share traded on the market, but it is applicable even on private businesses. There are some privately held companies which are very valuable companies. And even if you are a privately held company shareholder, you would not want the board to be compromised. Simple example, and from the geography where I operate out of. The largest stock exchange we have in India is National Stock Exchange, right? In today's terminology, National Stock Exchange is one of the best exchanges across. And as a shareholder of NSE, which is an unlisted company, right? NSE still is an unlisted business. Anything that goes wrong with National Stock Exchange has a severe impact on the financial system or on the capital market, equity market of the country. So even the regulators and the companies would ensure that private companies also follow some good board corporate governance practices. But yes, public companies are more under scrutiny. Private companies are not under scrutiny as much as public companies, but it's applicable to both. Let's put it this way.
Thanks.
Now, the board typically has committees, and these committees have specific roles. Every company has a board. For example, there are 10 members on the board. Out of the 10, those 10 members will be part of committees. First, audit committee. By the word itself, the role of an audit committee is to ensure that financial information reported by the company is correct, accurate, reliable, relevant, and timely. So everyone in the board who has an expertise in audit, tax, finance, accounting, as I said, will be part of this committee so that they know whatever is happening is correct, incorrect, is there some measures to be taken. So out of the board, you will take 3 members and possibly create an audit committee. Then the governance committee. They are responsible for governance, board of trustees, to guarantee that the organization embraces good corporate governance practices. So people with work experience in corporate governance, shareholder resolutions, etc., will be part of this committee. Remuneration, this is sometimes also called as nomination and remuneration committee. So in some of the publications, you will also find the word nomination and remuneration committee. Their job is first to nominate executives, right? So if you're finding a CEO, looking for a CEO, CXO position, they nominate people. And along with nominate, they also ensure that the compensation is set for executive management. They generally are responsible to set compensation for executives. They would like to set executive management compensation to encourage the management and act in ways that enhance the company's long-term value and profitability. So their compensation should be competitive enough. They include only independent board members on the committee and linking executive compensation to long-term profitability of the company. A lot of companies nowadays also publish this data that, okay, if we have an audit committee, in an audit committee, there are 4 members. Out of 4 members, 3 are independent members. So generally now do companies tell you this. Companies tell that, okay, 75% of my audit committee is independent, which means they have nothing to do with the business. They will take decisions independently. Maybe remuneration committee, 100% of the committee is independent members, which means the CEO is not part of remuneration committee, and therefore, your friends in the company will not be able to influence the CEO to push for a higher pay. So such things can happen where companies may appoint only independent members on the board or on these committees largely. Like nominations committee, to distinguish candidates who are met all requirements to serve as directors and suggest their nomination for election by shareholders. Like audit committee's role is also to appoint auditors. Who will be the auditor? Will it be Deloitte or PwC or someone else? Audit committee decides that. Risk committee, the committee oversees establishing enterprise risk management plans and monitoring their implementation. And again, investment committee, the board surveys material investment opportunities proposed by administration and considers their suitability. Now, these are not the only committees. Let's put this way. There is a committee which is also called as shareholder grievances, right? So there is a committee which only takes care of grievances from shareholders. So this committee's role is to take care of shareholder complaints and address the complaint and ensure shareholder grievances are resolved, right? So it's like a classroom. You make different teams. Each team is responsible for a specific function. Company board of directors act in a very similar way. The company can create committees, and each committee takes care of different aspects associated with the business and stakeholders. All of this information obviously is published in the annual report, right? So even the committees, the members in the committee, how many times did the committee meet, what are the decisions they have taken, everything is published in the annual report. Now, the stakeholder relationships could be determined by market factors. How much do you engage your shareholders, shareholder activism, and competition and takeovers? When we say shareholder engagement, does the company take shareholder opinion, views before taking important decisions? In certain cases, it may be mandatory for the company to reach out to shareholders, but in certain other cases, it may not be mandatory. Still, does the company reach out to shareholders and engage them before taking a decision? They get their view and opinion. Then, how does the company handle shareholder activism? Simple example, shareholder activism means shareholders generally either oppose certain decisions taken by the management, or they can vote in the favor. Now, let's say shareholders oppose a decision, right? Or the shareholders raise a concern, right? The concern could be very simple. For example, the shareholders come and say in an annual general meeting that we believe our company is offering compensation to the CEO, which is higher than what competitors offer to their CEO. Very simple concern, where the shareholders are raising a concern that the company is offering $10 million as a compensation to the CEO, whereas all other CEOs in the same sector, same industry, are on an average getting $8 million. Perfect. Now, this is the shareholder concern, that why are we offering $2 million extra compensation? Now, company needs to take a decision around it. Company can act two ways. Company can ignore this and continue paying this. The shareholders can't do much. Minority shareholders can't do much. Second, the company listens to the shareholder, maybe appoints a HR consultancy firm and asks the HR consultancy firm to present a detailed report that is this something which is valid? Are we offering more than the market? And if there is no reason to offer more, make a correction, make a course correction, revise this to $8 million and showcase to the shareholders that we are in sync and we are working towards your benefit. Because the $2 million which will be saved straight away gets added to your profitability. And this money can be given to the shareholders as dividends. So if shareholders are active, if shareholders are engaged, then the corporate governance standards are generally pushed higher. Companies are more concerned. Companies are always on the toes because they know shareholders are going to ask them. There is a very active shareholder base. The management will be questioned in the annual general meeting. And in such a case, the corporate governance standards automatically start taking better shape and priority in management discussions. Then, how much is the competition and what are the takeovers, mergers and acquisitions happening in the market? If there is a lot of competition, there are mergers and acquisition, market is very hot on mergers and acquisition. The companies would tend to focus on good corporate governance practices because they would know any lapse on corporate governance is detrimental in a highly competitive market. Then there are non-market factors. How strong is the legal environment in a geography? Certain developed markets, certain developing economies have a very good legal framework. And that legal framework pushes for corporate governance or betterment of corporate governance. Media raises issues, highlights poor corporate governance, and all of this pushes the company to follow good practices under corporate governance. But if you don't have media who's raising issues, legal environment is not as strong as it should be, the management and the company is not motivated to follow best practices or believe there are no advantages of being great on corporate governance. So there are certain market factors which determine the level of corporate governance, and there are certain non-market factors which determine the level of corporate governance. It's saying as if there's a traffic police, right? If there is a traffic police, maybe the traffic goes as per the rules and regulations. And as soon as you remove the police, the traffic is haphazard. Corporate governance is very similar. In general, if there are checks and balances, laws and regulations, a strong media, a strong shareholder group, in such case, corporate governance flourishes. Risks and benefits. Shortcomings in stakeholder management system can cause various risks for stakeholders and organization. Look, if there is a risk to the organization, it's a risk to the stakeholder. The stakeholder will not be left untouched. Like weak control systems. If your company has very weak control system, money could be siphoned off. A lot of times we have heard this, that money was siphoned off from the business, right? Someone withdrew the money. No one knows where the money went, who paid. So weak control systems are a problem. There are always possibilities of frauds, and not necessarily financial frauds. There is a possibility that a fraud is conducted on inventory, on obviously cash, but everything will have a financial impact. Then ineffective decision making is also a problem. Ineffective decision making is a signal that you don't have a control on the business. You're not sure what is right for the business. There's legal, regulatory, and reputational risk. As soon as the corporate governance issue is highlighted, the first thing that the company loses is its reputation in the market. People don't trust, right? For example, there is a news on corporate governance that there is a lapse. Now, even before people get into details of what is the lapse, how bad it is, what are the repercussions, how much is the loss for the business, we are not even looking at details. The equity screen flashes, there is a corporate governance issue discovered in the company. Before even people get into the depth of the issue, option number one that every shareholder will do, they'll sell the shares. In equity market, there's a very simple saying. You sell first and then you think what it needs to be done next. Because if you think, by the time you finish thinking, the stock price would collapse 90%. You're too late. So sell first and then think, why did you sell? So this can have a very, very negative impact on reputational risk. And any reputational risk also brings legal and regulatory risk with it. You will then have inquiries from various government departments. You could have, inquiries from a legal perspective. All of that is negative because it consumes management bandwidth. It also shakes the confidence in the business. And once the business confidence is lost, the consumers, the vendors will pull back. It's a rolling ball. It keeps getting larger and larger as an issue. So it snowballs into a much larger problem from the market perspective. Finally, culminating into what is called as a default or a bankruptcy risk. If customers flock, if your vendors flock away, if lenders stop working with you, share price already is correcting, it's a reputational risk translating to a legal regulatory default and eventually a bankruptcy risk. This is typically what we saw with Lehman Brothers. Once the issues started unfolding, no one wanted to do business with Lehman Brothers, right? And eventually the stock price kept correcting and correcting and correcting. The more the stock price corrects, your employees are also losing money because the employees were given ESOPs. And your employees are going to jump the ship. They are going to join someone else. And that is a fundamental problem for some of the businesses. On the other hand, a good corporate governance rewards. Does it look like? You have operational efficiencies, you have very good improved control processes, better operating and financial performance, you have a very low default risk and cost of debt. Remember, cost of debt is associated with the risk of default. The higher the default risk, higher is your cost of debt. Because the person who's going to give you the debt is taking risk. So he's going to obviously charge higher for taking that risk. Perfect. Let's give some practice questions. First one, which of the following statements regarding stakeholder management is most accurate? Company management ensures compliance with all applicable laws and regulations. Directors are excluded from voting on transactions in which they hold material interest, and the use of variable incentive plans in executive remuneration is decreasing. So this is asking us which of them is most accurate. Now, when we are saying what is most accurate in terms of policies here, company management ensures compliance with all applicable laws and rules and regulations. They should, right? The most important is directors are excluded from voting on transactions in which they own material interest. This is not decreasing. There's no way to tell whether this is decreasing or increasing, right? So in general, from a company stakeholder management perspective, and we are talking about stakeholder management perspective, right? That is why I'm not selecting option A. I'm selecting option B because the question is about stakeholder management. So the right answer should be B. Which of the following represents a responsibility of a company's board of director? Implementation of strategy, enterprise risk management, considering the interest of shareholders only. Very important word, shareholder only. Always remember, it is not only shareholder. You have to look at stakeholders. So it's not only shareholder, stakeholder. The responsibility of the board is enterprise risk management. Strategy implementation is management responsibility. This is what the CEO, CFO, CXO has to do, the management responsibility. The board has to ensure enterprise risk management. Which of the following statements about non-market factors in corporate governance is most accurate? Non-market factors. Stakeholders can spread information quickly and shape public opinion. A civil law system offers better protection of shareholder interest than does a common law system. And vendors providing corporate governance services have limited influence on corporate governance practices. Perfect. So what should be the answer here? This is non-market factors, please remember. Non-market factors. Generally, if you remember, we said shareholders activism. This is an example of stakeholder or shareholder activism. This is part of market factors, right? You are trying to shape market opinion. And vendors are also stakeholders. So this is again nothing but market factors. Law, legal, we said is a non-market factor. The difference between obviously civil and common law, not something which is important from our perspective, but just quick. Common law, the law is lawmakers, they look at precedent examples and make laws. While in civil law, it's more or less codes written, and you simply follow those codes. So from our perspective, legal is a non-market factor, and therefore the non-market factor is something that we are talking about in terms of contribution to the corporate governance. Which of the following statements regarding corporate shareholders is most accurate? A cross-shareholding helps promote corporate mergers. What is cross-shareholding? Cross-shareholding means one of my company A owns shares in company B. Both are my companies. Company B owns shares in C. Company C, A owns shares in C. So this is cross ownership where each company owns shares in other companies, right? And C can also own shares in A. So it could be cross ownership, cross holding. This helps promote corporate mergers, which I will be looking at most accurate. Okay. Dual class structures are often used to align economic ownership with control, and affiliated shareholders can protect a company against hostile takeovers. This is from a corporate shareholder perspective. Now, what is affiliated shareholder? Affiliated shareholders are sort of shareholders who are your friend. Simple language, they are your friend. This could be individual shareholder. This could be a large, a trust. This could be a corporate shareholder. They are going to protect you from a hostile takeover. What is a hostile takeover? A hostile takeover is an unfriendly deal, which means you don't want to sell your company, but someone is looking to acquire your business. And if someone is looking to acquire your business, how will you protect yourself? Someone acts as your friend and does not sell their shares. Classical example, company A, the promoter has 32% shares. Company B and company C. Company B has 19% shares in company A. And company C has already purchased 49% shares from the market for company A. So company C wants to now possibly acquire A. And if they have to acquire A, they need 2% more. They can call B and they can say, okay, give us 2%. B denies. B says, I'm not going to sell any of my shares. And therefore, B is acting as an affiliate shareholder for A. And B is saying, I'm friends of A and I can't sell my shares. So C cannot acquire the business. Hostile takeovers are generally possible when promoter ownership is less. When promoter ownership is less, right? So someone can acquire your shares from the market and go for a hostile takeover. An affiliate shareholder can therefore protect your company in such a case. Which group of investors or stakeholders would be least affected if the firm's financial position weakens? Your financial position is weakening. Which company stakeholder is least impacted? Look, if the financial position is weakening, suppliers obviously are impacted. Their payments have to be made. Customers also get impacted because if the financial position weakens, the company may have a problem to that extent, right? But they will be least impacted because if you purchased a product, you don't care what the company financial position happens from there. Your product is doing fine, you're good. Managers and employees obviously get impacted, right? So the least affected guy is the customer in this category. And therefore, stakeholder word is important. Which of the following represents a principal agent conflict between shareholder and management? Risk tolerance, multiple share classes, and accounting and reporting practices represents a principal agent conflict.
Risk tolerance.
Risk tolerance is the least impacted. Yes. A principal agent conflict, risk tolerance is the least impacted category for us. Simple example, you can think about it this way. If you are a shareholder and if you have a diversified portfolio, which means you don't have only one share in your portfolio, but you have multiple types of shares in your portfolio, multiple companies, then you are least impacted. Your risk tolerance is much higher. Even if there is a conflict between shareholders and management, your risk tolerance will be very high because you have a diversified portfolio. So risk tolerance becomes your thing, which is representing a principal agent conflict here. Which of the following issues discussed at a shareholders general meeting would most likely require only a simple majority vote for approval? Simple majority vote of approval.
Election of directors.
Yes, generally, when you're looking at a shareholders general meeting, right? What are the issues discussed at a shareholder general meeting? Mostly it is election of directors. Voting on a merger, amendment to bylaws is typically not discussed at a general meeting, right? A general meeting is more about election of a director. These are things for which you will have an extraordinary meeting to be arranged. Which of the following represents the responsibility of a company's board of directors? Implementation of the same question, right? Once again, implementation of strategy, enterprise risk management, consulting. Oh, same question. I think it's a repeat question. Enterprise risk management, which we did, I think, previously. Yes. Question number 2, question number 8 are the same. Perfect. So I think that is all that we have for today's session. Questions? Anything? Next class, I think tomorrow is more interesting. We have a lot of discussion around working capital and capital investment allocation policies, something which will be more practical oriented. Today's session was more theoretical. But yes, questions. Any questions from our previous sessions on financial statement or topics that we have covered? As I said, I think please, if you have questions, bring them to the class, not an issue. We can have with them as part of our classroom sessions also. Nothing? All good? Okay, perfect. If no more questions, then we'll have a early finish today for you. I'll back it up here. Have a good day.